Essay 240, which is going to be covered with this video. The name of the essay is Auditor's Responsibility Relating to Fraud in an Audit of Financial Statement. Fraud is the main thing which we are going to cover in this particular standard on auditing. It is a very big video because it's a very big standard and a very important one as well from the point of view of your examination and even from the point of view of your interviews, especially for those who are looking for articleship. This is one common question which may be asked from each one of you. So this, as I told you, this video is concerned about fraud. So first of all, we need to know what actually fraud means. Starting from here, it is written over here that is the misstatement in financial statements can arise from either fraud or an error. So first of all, we need to know the difference between fraud and error. Fraud is an intentional thing. Error is an unintentional. Fraud, you are committing something wrong and you have an intention to do the same. But in case of an error, it has been done by a mistake. It may be you were not able to, you didn't know that you have committed an error. So there's no intention to deceive or conceal anything. I mean, to hide something which you have done, something wrong which you have done. So this is basically totally unintentional. But over here, you had an intention maybe to earn some extra money, or you wanted to get a good kind of promotion or something, maybe committed by managements to get some increase in dummy sales figures. So in fraud, we can say is an intention. You have an intention to take a benefit out of it. So the fraud is intentional misstatement. It can be a misstatement or it can be an omission. Misstatement is something which you have done in a wrong way. Omission is that you have not recorded something. Misstatement could be like, as I told you, dummy sales. You just went on to increase your sales figures so as to boost up your shares prices, or you're just doing something. I mean, recording. You received some money from Mr. A and recording it to Mr. B just to give it an advantage to Mr. B. So these are some misstatements, and they are intent. You have an intention behind it. Omission could be that there was a receipt of from the sale of scrap, and you have written that it was just discarded. You didn't receive anything. So this is an omission of the complete transaction. Omission of the amount or omission of a disclosure. Disclosure, you may be required to disclose something as per the laws, but you are not disclosing them. So this again with an intention. So this is again a fraud. So fraud is an intentional misstatement or omission of amount or disclosure. It can be a misstatement of amount or omission of amount, or it can be of disclosures in the financial statement. Obviously, it has to be in the financial statements. So misstatement in the financial statement can arise from either fraud, which is intentional, or error, which is unintentional. This is the basic difference between fraud and an error. And so misstatement arise from these two things, right? So, but the auditor is concerned just with fraud because errors are, unintentional. They can be corrected, but if there is a fraud, the auditor has to see whether he needs to evaluate the effect on his audit report. So in fraud, this is what the auditor is concerned with. So auditor is concerned with fraud that causes material misstatement in the financial statement. Not all, the auditor is not concerned with all the frauds. For example, if you take the example of Tata, the Tata Group, which includes your Tata Indicom, Tata Motors, etc. If there is a fraud of maybe 10,000 rupees by a manager or by an employee, and the turnover of Tata Group is maybe, I do not know exactly, maybe close to 10,000 crores. So if there's a fraud of just rupees 10,000, you won't give a qualified or an adverse opinion that the financial statements are not true and fair. One thing I want to tell that if it would be quite difficult for you to go through all my videos if you do not know what adverse opinion or qualified or a disclaimer of opinion means. If you have an intention to watch all my videos, it would be better if you go through videos on SA 700 and 705, 700 and 705, these two videos, so that you can know what opinions are all about. Otherwise, if you just want to watch this video, it's good enough. So if there's, as I was telling you, that if there's a fraud of 10,000 rupees in an organization which is having a turnover of 10,000 crores, there's no use of giving an adverse opinion. Adverse opinion is that you're giving that the financial statements are not true and fair. It is not good for the image of the organization. It won't be definitely won't be good for the image of Tata Group. And so we are concerned with just the material misstatement. Material means significant. Material in the sense that they are those items which affect the judgment of the users of the financial statement. If there's a user of the financial statement who is looking through the financial statement, if a particular if there's a particular item's disclosure or a change in particular item can um, affect the decision of the user, then it is known as material, right? So the auditor is concerned with frauds, only frauds that causes material misstatement in the financial statement. This is very important. It has a material effect on the financial statement. Now, who is responsible for preventing and detecting a fraud? There has to be someone who is responsible for prevention. Prevention is something which comes before detection. Prevention is that you do not allow the fraud to occur. Detection is that a fraud has occurred and you have now detected that fraud. So the detection is when you're detecting the fraud, you need to correct it as well. But prevention is always better than cure, as you all say. So who is responsible to prevent the fraud, or who is responsible to detect the fraud? It is the responsibility of the management and not the auditor. There was a famous case of Kingston Cotton Mills, under which the auditor was declared to be a watchdog and not a bloodhound. That is, the auditor do not is not required to run after frauds in looking for frauds. And I mean, if there is a fraud, he has to identify it. If the auditor has an indication that there might be a fraud, in that case, he should perform additional procedures to confirm that whether there is actually a fraud or not. But if he do not have any kind of indication of a fraud being committed by the management, it's not the responsibility of the auditor. It is the responsibility of the management to prevent and detect these frauds. So the responsibility for prevention and detection of fraud, the primary responsibility is of management and those charged with governance. The primary responsibility of this is of the management and TCWG. Who are TCWG? I guess first of all you need to know this. See, those charged with governance comes above your management. They supervise the management's process. So TCWG may include your audit committee, the board of directors, the remuneration committee who decide the remuneration, shareholders grievance committees. If the shareholders have any kind of grievances, that is, they have any problems, they can report to these committees. Independent directors, executive committees. So these are those charged with governance. Right, so it is their responsibility to prevent and detect fraud along with the management, and not the responsibility of the auditor. Right, so the responsibility is that of the management and TCWG. They are committed to create a culture of honesty and ethical behaviors. Everyone in the organization should be honest and should follow the ethical behaviors or ethical guidelines. So the management is committed to create such an environment or such a culture where everyone is honest and everyone is following ethical values, right? So this is the responsibility of the management and TCWG. Now, what is the objective of SA 240? Why we introduced this particular SA 240? There are two things in this particular case. The first thing is that to discuss the auditor's responsibilities. These two objectives are something which we are going to discuss in the whole video, right? So the first thing is auditor's responsibility. Now, to discuss the objective of this SA 240 is to discuss auditor's responsibility relating to material misstatement which is resulting from fraud and error. If there is a material misstatement which is resulting from a fraud, there was a fraud which gave rise to material misstatement, that is a misstatement which is material. A fraud gave rise to material misstatement. Now, what is the responsibility of the auditor? And the other objective of this particular essay is to provide guidance, that is to guide the auditor so as to the procedures that the auditor should perform. What procedure he has to perform if he suspects, that is, if he has an indication, if he thinks that there is a fraud or error in the financial statement. He is not sure, but he suspects, he has a suspicion about a fraud or error to have been in the financial statements. So it provides guidance to the auditor regarding the procedures that the auditor should perform under such case. This particular essay provides guidance to the auditor as well, and what is going to be the auditor's responsibility. So the first thing we are starting with is the responsibility of the auditor, then we'll move on to the procedures as well. So the first responsibility of the auditor is to Obtain reasonable assurance. One thing I want to make sure to you all is that in auditing we can never obtain absolute assurance. Absolute assurance is that you're 100% sure about something, but reasonable assurance is that you're quite sure. You may be 90% sure, 99% sure. So in auditing, there's no such thing as absolute assurance, because it is not possible to obtain 100% assurance. There is going to be always a risk, maybe due to inherent limitations of the audit. If you're going for sampling, that is, you're examining just a few items, maybe 90 out of 100, there is still a risk that out of those remaining 10 there could be a misstatement. So you can obtain just reasonable assurance and never an absolute assurance about anything in audit, right? So the responsibility of the auditor is to obtain reasonable assurance, that if even if just one more thing that I want to make you clear, I guess I gave rise to a doubt in your mind, that even if the auditor is examining 100% of the items, that is 100 out of 100 items, even in that case there could be you cannot give an absolute assurance, because you cannot make sure because you're coming for audit maybe for 40-50 days, or even throughout the period. But still there can be fraud. Definitely there is still maybe of 0.1% chances that there can be a fraud which has not been detected by you. So there is always a possibility that there can be something fraud or some error or some misstatement which you were, as an auditor, not able to detect, right? So you can obtain just reasonable assurance, and this is the responsibility of the auditor, to obtain reasonable assurance that the financial statement taken as a whole are free from material misstatement. You have to obtain assurance that there are no material misstatement in the financial statement, and a reasonable assurance. You need to obtain reasonable assurance. Now, the same thing which I was telling you has been written in Essay 200. I've already made a video on Essay 200. You may watch my video on that maybe after this video. So in Essay 200, I've given some inherent limitations, which includes, first thing, as I told you, that you would be given some time frame within which you have to complete the audit. So it may not be possible for you to go for 100% examination. You may examine 70 items out of 100, or 50 items, or 40 items out of 100. So there's always a risk that there can be a misstatement in the other items. Apart from that, the management may not provide you all the information. So these are some inherent limitations which cannot be separated from audit, right? So due to these inherent limitations of audit, there is unavoidable risk that some material misstatement in the financial statement will not be detected. This is unavoidable. This risk will always remain there because of the inherent limitations of audit. Because these limitations cannot be separated from audit, therefore the risk also cannot be separated from audit. This is unavoidable. You cannot avoid this risk that some material misstatement of financial statements will not be detected. Even though the audit is planned and performed in accordance with essay, you are following all the standards in auditing, but still there would be some risk. Now there are some two cases. The first one is that risk of not detecting material misstatement resulting from fraud, and risk of not detecting material misstatement resulting from error. See, there can be two kinds of material misstatement. One which is resulting from fraud, and the other one was resulting from an error. This was a fraud, this was an error, as I've already discussed with you. Now the risk of not detecting this is always more than this. Risk of not detecting fraud is always more than risk of not detecting an error. Why? Because in case of fraud, the one who has committed the fraud will take steps to conceal it, will take steps to hide the fraud, so that the auditor is not able to identify those frauds. So he has taken some steps, right? So the risk of not detecting material misstatement which are resulting from fraud is higher than the risk of not detecting material misstatement resulting from error. Because fraud may involve carefully organized schemes which are designed to conceal it. You've taken some efforts, you have taken some steps to conceal it. And in a similar manner, we have another case, that risk of not detecting material misstatement resulting from management fraud is more than the risk of not detecting one from employee fraud. Over here, management is committing fraud. Over here, employee is committing fraud. it won't be easy for you to detect frauds which are committed by management. Why? Because management has power over the financial statements. It can manipulate the accounting records because management has control over those accounting records. So therefore, since it can manipulate the records, it is difficult for the auditor to identify such frauds. Right. So we can say that risk of not detecting a material misstatement which is resulting from management fraud is more than the risk of not detecting one from employee fraud. So these were some smaller and simpler two cases. Now, the auditor is responsible for maintaining an attitude of professional skepticism throughout the audit. Professional skepticism already been discussed in SA 200, but still, I mean, I'm not asking to you to watch that video first. But I mean, if you are so far in this video, so professional skepticism means a questionable mind, that you doubt situations, you are vigilant. That is, you're looking uh, around you, what is happening around you. That is, you're looking for any indication that may indicate that there is a fraud. So you're, but all at the same time, you're not running after to look for frauds, but you have an open mind. You're looking around you carefully, that if there is any indication, you will be able to catch it, right? So auditors should maintain such an attitude of professional skepticism throughout the audit. He should be like this. Not with Now, this is very important, that if the auditor has any belief that the management is very honest, or if he has any belief that there is integrity among the management, that is, the management is a single unit, he should, for the time being, when he's an auditor, he should forget about this thing. He should not think that the management is honest. When he's performing the audit, he should think that they can be a material misstatement due to fraud. So notwithstanding auditor's past experience, his past experience says that the management is honest. So notwithstanding, that is, ignore this. So, notwithstanding auditor's past experience of the honesty and integrity of the entity's management and TCWG, those charged with governance, auditor should recognize the possibility. Auditor still should recognize the possibility. That is, whether it is honest or not, he should still recognize the possibility that a material misstatement due to fraud could exist. That is, there could be a fraud which is a result of a material misstatement, right? Ignore whether the management is honest or not, unless however, at the same time, if there is no doubtful situation at present, if there is no doubtful situation present, the auditor can rely on the records and documents, right? So unless doubtful situations are present, auditor may accept records and documents as genuine. That is, he shall consider that the records and documents are genuine because there is no doubtful situation. Now, conditions that cause the auditor to believe that a document may not be authentic. Conditions which are making the auditor believe. There are some conditions that makes the auditor believe that the documents are not authentic, they are not genuine, or that the terms in a document have been modified. That is, the terms have been changed. So there are some conditions which says that the documents are not genuine or they have been changed. What the auditor should do? He should perform further investigate for the procedure. He should further investigate the matter, that why he's thinking so, examining these conditions, whether they are rightly been indicating that they can be a misstatement, or whether they in reality, whether they are not authentic or genuine. So he should further investigate the matter. Then response to inquiries of management or TCWG are inconsistent. He inquired something from the management or those charged with governance, but different people are responding differently to the same thing. You are obtaining audit evidence regarding machinery A. From one source, you are getting that the machinery was purchased in 2015. From the other source, you are obtaining that it was purchased in 2014. The other source, from the third source, it is saying that the machinery has been leased. So all are inconsistent. Now, what the auditor should do? He should investigate the inconsistency, right? So that's a very good and a very big essay. Now, what are the objectives of the auditor? The first thing, the auditor should identify and assess the risk of material misstatement in the financial statements due to fraud. The first thing is that he should identify and assess the risk. There is a risk of material misstatement in the financial statement which is due to fraud. There is a fraud which is giving rise to a material misstatement. First of all, identify this risk, assess this risk. Then obtain sufficient and appropriate evidences regarding these assessed risk. So obtain sufficient and appropriate audit evidence about the assessed risk of material misstatement due to fraud. I obtain sufficient and appropriate evidence regarding these things. Then respond to those assessed risks. Respond appropriately to the identified or suspected frauds. Right? First of all, identify, then obtain evidences, then respond to them. This is the objective of the auditor. Identify, obtain evidence, and then respond. Now, discussion among the engagement team. First of all, you need to know what engagement team is. Engagement team is a team which is going to audit the accounts of the client. Uh, an engagement team may be consisting of the partner for sure. Apart from the partner, they can be paid assistants, they can be chartered accountants, they can be third year articles, second year article, first year articles. So this is an engagement team. So what are they going to discuss among themselves? They're going to discuss possibility and suspicion of material misstatement. They will discuss whether a material misstatement is possible or not, because they are auditing, or they have different roles in the engagement team. One is auditing, maybe one is preparing a bank reconciliation statement, the other one is vouching the maybe receipts, the other one is vouching sales, the other one is doing examining the purchases, etc. And so they'll discuss among themselves the possibility of material misstatement in their respective areas. Then job allocation among the audit team, as I was telling you, one is taking the sales department, the other one is taking the production department. One has accounts of for the month of January to March. The other one is having from April to June. Right. So there's a job allocation among them. Then how the results of audit procedures followed by the members of audit shall be shared among. So they are performing different different audit procedures. So they would be sharing among themselves the same thing. So how they are going to share these things? So these kind of discussions take place between the engagement team. Such discussions shall occur again, notwithstanding the engagement team's belief that the management is honest, or they have integrity. So for the time being, forget about this thing that management is honest or management has integrity. That is, the management is a one single unit. They are not divided. And so for the time being, ignoring this, you should discuss this particular discussion shall occur. Right. And so now we have risk assessment procedures and related activities. We are already 22 minutes in the video, and we're still left with a lot of work to do. Risk assessment procedures and related activities. This is something which we are going to discuss in detail. That is, these procedures includes that you need to inquire from the management and others, and you need to inquire from TCWG. So what we are going to inquire, will be discussing later on after these 3 points. Then unusual or unexpected relationships have to be identified. If there is any unusual or unexpected relationship, you need to identify those and evaluate whether such relationships identified in performing analytical procedures. You perform analytical procedures. Analytical procedures are always related to relationships. Maybe you perform ratios. You examine the trends, like what was there in the previous year, what is there in the current year. You examine maybe debt equity ratios, etc. So by performing those analytical procedures, you evaluate whether they indicate a risk of material misstatement due to frauds. These relationships basically indicate any kind of fraud. Then you need to obtain other information, consider other information, any other information, whether other information is obtained by auditor indicates a risk of material misstatement, whether these basically other information indicate again a risk of material misstatement due to fraud. And then we have evaluation of fraud risk factors. This is very important. First of all, we need to know what fraud risk factors is. There are some events or conditions. Events or conditions which persuade, which pressurizes, or which provide an incentive to the maybe the employee or the management that you commit fraud and you will be rewarded. In the sense that if the management, one of the basic and the most common reason why people commit fraud is money. You get money by committing a fraud. You commit a fraud and you get maybe 10,000 rupees by misappropriation of cash, which is a fraud. And 10,000 is a very small example. People commit fraud to earn lakhs of money. So you have an intention. So this is a risk factor. This is a fraud risk factor that you earn additional money, not exactly earn, but you get additional money by committing frauds. And there could be a pressure, maybe you might be, if the higher management or the senior managers are committing fraud and you are working at a junior level, if you do not maybe support them, you may be fired, you may have to resign from the organization, you would lose your job. So this is the pressure, and again this pressure leads to a fraud risk factor. So there are some events or conditions that indicate an incentive or pressure. It can be an incentive like on getting additional money, or it can be a pressure to commit fraud or provide an opportunity to commit a fraud. You're getting an opportunity, there is an opportunity whereby you can commit a fraud. So these are the fraud risk factors. However, fraud risk factors may not necessarily indicate the existence of fraud. If there is a fraud risk factor, that doesn't mean that is definitely going to be a fraud, because there are still are some good people where people have the chances, have the incentive, have the pressure, but they won't commit fraud. So next thing which we have is evaluation of fraud risk factors. So I've already told you what fraud risk factors are. Auditor shall evaluate whether the information obtained that the auditor shall evaluate whether the information obtained indicates that one or more fraud risk factors are present or not. Right. So the information which he has obtained, evaluate whether there are some fraud risk factors present. Now, the main thing which we are going to discuss is the inquiry from the management and others within the entity, or TCWG, which we are moving on to. So the first thing we have is inquiring the management and others within the entity regarding what? So the first thing we are going to inquire from the management is, what is the management's assessment of the risk of material misstatement due to fraud? That is, management has already assessed that whether there is a risk of material misstatement, and what is the assessment of the management is something which the auditor is going to inquire from the management. That is, what do you think, what is your assessment regarding this? Then the management's process, the auditor shall inquire from the management regarding its process, how it identifies and assess, how it identify and respond to those risk of material misstatement, of fraud in the entity, how it is identifying and responding to them. Then what is going to be the communication, what is there in the communication between management and TCWG, inquire from the management. Then management's communication to employees regarding ethical values, etc. So management's communication to, we are inquiring from the management regarding these this communication and this communication. So the management communication to employees regarding its views on business practices and ethical behaviors. So we are inquiring regarding this as well, about the what you have communicated to the employees regarding ethical behavior that they need to follow, or the business practices that they need to follow. And there's a statement that if the entity has an internal audit function, the auditor shall make inquiries of the internal auditor, because there is an internal audit function. Internal audit basically means that they themselves are appraising, that is evaluating their own performances, and there would be definitely an internal auditor who would be evaluating. So you can also make inquiries of the internal auditor as well, if the entity is having an internal audit function. Now the next thing we have is inquiring TCWG, that is those charged with governance. So what can we inquire from them? First of all, understand how TCWGs supervise management's process. TCWG is supervising, they are above the management. So how they are supervising the management's process is something which we are going to inquire from TCWG. Then ask TCWG whether they have any knowledge of fraud or affecting the entity. Do they have a knowledge of maybe they have identified a fraud? So do they have any knowledge of such frauds? Please communicate to the auditor. So this is what we are going to inquire from TCWG. So as I already told you, who all are included in TCWG in the very first maybe in the very first 10 minutes of this video. Then we have auditors discussion or communication to TCWG, what they are going to discuss with those charged with governance. First thing we have is failure by management. That is, the auditor has to communicate or discuss with those charged with governance if the management has failed on some point regarding to address appropriately material weaknesses in internal control. There was a material weakness in the internal control which has been identified during the prior period, audit. In the previous period, when you were auditing the previous period financial statement, you identified a particular material weaknesses in the internal control. You reported this to the management, but the management has failed to address this particular problem, to address this material weaknesses, that is to remove these weaknesses in from the internal control. So if this is the case, you need to communicate or discuss the same thing regarding the failure of the management to those charged with governance. Then what the auditor personally thinks, what is his own perception or evaluation about the weaknesses in the internal control. And then what is going to be his overall audit approach, including the audit additional procedures that he is going to perform, that the auditor has decided to perform. So overall audit approach needs to be communicated to TCWG, including additional procedures which the auditor has decided to perform. These are very simple points which need to be communicated, and any other matter needs to be communicated which is related to fraud, that are in auditor's judgment relevant to their responsibilities, that they need to, the TCWG need to know about, the needs to be known, that these frauds are there. So any other matter which is related to fraud and auditor thinks they are relevant needs to be communicated to TCWG. These are some discussions that need to be done with the TCWG. Over here we had inquiring from TCWG, that is we were inquiring from TCWG that you provide us such these information, that how you are supervising the management's processes, and whether you have any knowledge of fraud or about affecting the entity. But in this particular case, we are providing the information to TCWG. Right, so this was regarding TCWG, and who are included in TCWG. You already know about that. Now we have identification and assessment of risk of material misstatement due to fraud. See, this is there's a separate standard in auditing as far as this is concerned, with the same name, that how you are going to identify and assess the risk of material misstatement. This is going to be in accordance with SA 315. I've already made a video on the same. Apart from that, when you will be watching this video, I'm not asking you to watch it right now, but when you will be going through this video, you will find that the objective is to identify and assess the risk of material misstatement. That is, if there is a material misstatement, now how you are assessing the risk of this particular thing. In identifying the risk, you need to obtain an understanding of the entity's environment in which the entity is operating. Now the environment is going to include the internal control as well. So the first thing is that you are assessing the risk. How you are assessing? By understanding the environment. How are you going to understand the environment is a separate issue, but included in this environment is going to be the internal control, right? You also need to obtain understanding of the internal control when you are identifying and assessing this risk. So the same thing we have written over here, that you need to obtain understanding of the entity's related control related to these risks, etc., including control activities which are relevant to such risks, right? So to obtain a thorough understanding, video on SA 315 would be a must. Then responding to such risks which you have identified, there is a separate video or a separate standard on auditing with the number of SA 330, right? 330. So now we have responses to the assessed risk of material misstatement. That is how we are going to respond to such assessed. We have first assessed the risk as per 315. Now we are going to respond to such risk as per 330. So with the responses would be that you need to maintain professional skepticism. I've already made this has been already been covered in SA 200, as I already told you. Then you need to assign. This involves assignment and supervision of personnel as per their capability. That is, on the basis of the knowledge of the employees, on the basis of the your capability of the employees, whether they are qualified enough to be a part of the engagement team, and you're assigning the roles on the basis of their experience. If they have good experience with the same client, you give them some kind of a bit difficult task which needs more experience, which needs more expertise. So then you're assigning the roles as per their capability. So assignment and supervision of the personnel as per their capability. Then accounting policies, you're evaluating whether accounting policies adopted by the entity indicate any fraudulent financial reporting resulting from management. management's efforts to manage earning. That is, your accounting policies which you have adopted by the entity, which have been adopted by the entity, are indicating that there is a fraud in the financial reporting. So this also needs I mean, this is a kind of you need to respond to these as well. These such accounting policies which have been adopted, then incorporate surprise element. That is, you need to include some surprise elements. That surprise may be in respect of the time, or it may be in respect of the items to be audited. That when you're going to the client site, you didn't tell them that maybe on, for example, today is 15th of Jan. So today is 15th of Jan. Now your next visit is going to be on a date which you haven't disclosed to the client. So say for example you came on 19th Jan and this was unexpected. So this is a surprise visit by the auditor. And not only this, if maybe he told that I will be coming on 17th Jan, he came at 7 he also came at 17th Jan, and but he didn't tell them that what he's going to do. So when he came on 17th Jan, he started auditing the cash, and the management didn't know that he's going to audit cash today. So this is a surprise element again. So the surprise can be with both respect to with respect to the date of audit and with respect to the items to be audited. So incorporate the auditor needs to incorporate surprise elements in the audit procedures that he's going to perform, in the nature, timing, and extent of audit procedures that he's going to perform. Nature would include the kind of audit that he's going to do, the items which are going to be audited. In some of my videos, I've given an example of one of my friend who's working with Thakur Vedinath and Ayer company, which is the auditor of the Prime Minister office. In the Prime Minister's office, he has been given a role to audit the Prime Minister National Relief Fund. You must have heard about this in your income tax. That there is a Prime Minister National Relief Fund where you get deduction under Section 80G. So he has been given the job of auditing the Prime Minister National Relief Fund. The whole engagement team has been given such a responsibility. So this is the nature. Timing is that they are auditing the accounts of, for example, 2014-15. This is the timing. Extent is that they are told to go through each and every transaction. They cannot go for sampling. They cannot examine 50 out of 100 items. This is not the option available to them. They have to go for the 100% examination. This is known as extent of the audit procedure. So in these procedures, they should adopt in surprise elements. Do not tell what is going to be your next step. This is known as surprise, right? Now we are already left with maybe it's right. So now we have audit procedures responsive to risks related to management override of control. What is happening is that the management itself made some controls, and now itself is not following those controls. It is overriding those controls. That is, it is breaking those controls. Now what the auditor has to do? So the management, first of all, is in a unique position. It has the power to break the rules. Maybe not the legal power, but it has the capacity to break those controls. So management is in a unique position to perpetrate fraud. Perpetrate means commit fraud. They are in a unique position to commit fraud, which no one will be able to get to know about this easily. Because of the management's ability, they have an ability to manipulate accounting records and prepare fraudulent financial statement. They can prepare the fraud financial statement because they are the one who are responsible for preparation of the financial statement. So it would be easy for them to commit frauds. So they are in a unique position to perpetrate fraud by overriding control. They can just override the controls, and you can easily commit some such frauds. Now, what the auditor has to do regarding this, the auditor shall determine whether the auditor needs to perform extra audit procedures because the management is overriding control. Now, what the auditor should do, he should perform additional procedures like testing the appropriateness of journal entries. He should examine the journal entries, inquire individuals involved in financial reporting process, those who are involved in the financial reporting process, that is recording of transactions, recording of journal entries, and etc. Everything from the beginning of a transaction, of giving vouchers, etc. Inquire from those individuals about the inappropriate or unusual activities. If they saw any inappropriate or unusual activity which usually do not happen in the organization or in the client's maybe premises or the accounting records. They should be inquired about this from by the auditor. Then review the accounting estimates. Management makes the accounting estimates. There's a separate essay, I guess 540 or 520, I'm not sure about this, on accounting estimates. You may watch my video on the same as well, where we are going to review the accounting estimates. Means accounting estimates basically includes your provision for bad debt. Say for example, you do not know what's going to be your actual bad debts, but you make a provision, so this is an estimate. So the auditor should review these estimates so as to see that the management is not unnecessarily decreasing the profit by increasing the provision for bad debts. And so this is another thing which the auditor can do. Now, the effect of frauds and errors on when you're considering the effects of frauds and error, we have two questions. One is the materiality, and the other one is effect on the audit report. Materiality, there's a separate essay 320 audit materiality on this, right? So you may watch my video on that. Effect. So this when we are discussing the effects of the frauds, we first need to know whether it is material or not. Which you will get to know about through the essay 320. Then if you want to know what you're going to what is going to be the effect on your audit report, whether in the beginning of this video I've told you that it would be better if you go through essay 700 and 705. So the same thing, you can know about what is going to be the effect in the audit report by these following these essay 700 and 705, right? So 705 is going to be regarding modified opinion, that is not good for the organization's image, and 700 is regarding unmodified opinion, that is that the auditor thinks that the financial statements are true and fair. So these are the effects of frauds and error on the audit report. Now we are going to evaluate the audit evidences. AE refers to audit evidences. Now, if there's a case that the auditor identifies a misstatement, that is, there is a misstatement. Now what the auditor has to do? He has two options. He has to do two things. First of all, evaluate whether such misstatement is indicative of fraud. You have identified a misstatement, but does this means that there is a fraud? Because see, on the very first page, I told you that the misstatements can arise from a fraud or from an error. So if you have identified a misstatement, what you have to do is that you need to evaluate whether such misstatement is indicative of fraud, whether it is arising from fraud. First of all, evaluate this. If yes, the answer, if in case the answer is yes, that it is a result of fraud, it is indicative of fraud to be specific, then evaluate the implication, evaluate the effects of such misstatement in relation to other aspects of the audit. What is going to have an impact on other aspects, other parts of the audit is something which you're going to evaluate. So evaluate the implication of the misstatement in relation to other aspects of the audit, particularly reliability of management representation. Management representation is again been covered in essay 580. This has been covered in 580. That's that you're going to consider the reliability of the management representation. Management representation is same as written representation, whereby you obtain written representation from the management, that they give it to you in writing, that what they feel, what they know. Basically, you can obtain written representation from the management that if they know any detail regarding any frauds or errors, so they give it to you in writing that no, we do not have any indication, or we do not have any knowledge of any fraud committed. So so in this case, if there is a misstatement and which is resulting from fraud, you have to doubt these management representation as well and its reliability. So we can say in the end that evaluate the implications of the misstatement, these misstatement in relation to other aspects of the audit, and particularly the reliability of the management's representation. Right. So now we have reevaluate. I mean, if you have identified a misstatement, reevaluate. Just a second. Right. So reevaluate the assessment of risks of material misstatement due to fraud and its resulting impact on NTE, that is nature, timing, and extent of audit procedure. So what you are doing is that you have found a misstatement earlier. You didn't know that there is a misstatement, and you had evaluated the risk of material misstatement. But since now you have identified a misstatement, you need to reevaluate the risk. That is definitely going to increase, because say for example, if you had audited 20 items out of 100 and you had you didn't identify any misstatement, so the risk was very low. But now when you identified maybe examined another 20 items, so now you are 40 out of 100 items have been examined, you found that there are 5 or 6 misstatements. So now you need to reevaluate the risk, right? So reevaluate the assessment of risk of material misstatement due to fraud and its impact which is going to have on written nature, timing, and extent of audit procedures. Basically, if you are going for sampling, you are auditing, say for example, 40 items of 100 out of 100, and you identified some misstatement in those 40 items. Now, what you need to do is you need to extend this. Basically, you need to take it on to maybe 60 items or 70 items, because the risk has increased. Now you need to perform additional procedures, right? So this was regarding the evaluation of audit evidences when the auditor identifies any misstatement. Now, if the auditor is unable to complete the engagement, that is, he's not able to, he's not willing, or he's not able to carry on his audit engagement. Now, there could be some circumstances which leads to such situations. So first of all, we are going to discuss those circumstances which may lead to the inability of the management to complete the engagement. So first circumstances is that no remedial action taken by the management for fraud or error reported. That is, the auditor reported some frauds or error to the management, and the management refused to take any refused to take any action regarding such a frauds or error which has been reported. Now, the second instance could be that the fraud is existing in all the departments. The whole organization is being suffered from frauds or errors. There are frauds or errors in the complete organization. Every department has a fraud. Everyone is in collusion with each other. They are helping themselves to commit fraud. So the condition of the organization is worse as far as frauds are concerned. Every person is committing a fraud. So in this case, the auditor has to maybe look for withdrawing from engagement. Now, there's a serious doubt on the competence of and integrity of management. The management is not competent enough, or they are not a single entity. For example, from one part of the management is saying one thing, and the other part of the management is saying the other thing, and these two things are different. I mean, they are inconsistent. The whole management is inconsistent between themselves. They have different groups in the management which are giving different directions to the auditor. So if the auditor doubts their competence, that they are not competent enough, they shouldn't be the management, part of management, that the auditor feels, and he doubts the competence and integrity of management, then also this may lead to inability of the auditor to complete the engagement. So now what the auditor has to do? First thing, in such circumstances, the auditor shall consider his legal and professional responsibilities. That is what the auditor should do as per the law, as per his professional responsibilities. Then he should report to the person who made the audit appointment. That is, there would be definitely a person who has appointed the auditor. Report to that person who made his appointment, which who recommended his name to the board of directors or to the shareholders to appoint such person. So report to that person. Report to regulatory authorities. It may be the Reserve Bank of India in case of non-banking financial companies. Then consider the possibility. This is the last resort. That is, consider the possibility of withdrawing. That is, whether you can withdraw from the engagement, whether you can resign from the engagement. If you can withdraw, in such cases, the auditor has some tasks to do. The first thing, he needs to discuss with appropriate level of management and TCWG. That is, he needs to inform TCWG or the management why he is resigning. That is the reason of withdrawal. He needs to communicate or discuss with those charged with governance and the management. Then consider the legal requirements of reporting to appropriate authority or legal or regulatory authority. As I gave you an example, that in case of non-banking financial companies, you need to report to the Reserve Bank of India. So the auditor shall consider if he has any legal requirement of reporting to a particular authority. So he has to communicate to those authorities that why he is resigning, or what is the reason of withdrawing from the engagement. Now, this is very important and interesting as well. In case the auditor is resigning, he is withdrawing from the engagement, but the entity has to appoint another auditor because the entity needs to get its account audited. So there would definitely be another auditor coming to audit the accounts of the entity. So there would be a communication between the present auditor and another auditor. So in such communication between the present auditor and another auditor, the present auditor cannot, I mean, should not disclose the his or tell his opinion to the new auditor. He just needs to disclose the facts of the fraud. That is all. So state only the facts about the fraud, not his opinion to the incoming auditor, that is the new auditor. He should not disclose the his own opinion. Just disclose the facts about the fraud, and that too with the permission of the management, subject to the client permission and professional obligation. So this is what the auditor has to do: disclose only facts and not the fraud, which the disclose only facts of fraud and not the not his opinion, right? So this was regarding the what the auditor has to do in case he is unable to continue his engagement. He see his legal professional responsibilities, report to the person who made appointment to regulatory authority, and consider the if he can withdraw or not. So now we are moving on to the management representation. As I've already told you, this will be covered in detail in SA 580. But still, what regarding what the auditor has to obtain this management representation, I've already told you that management representation and written representation are one and the same thing. MR and WR is one and the same thing. So the auditor shall obtain written representation from the management regarding these four things. First thing, that the management acknowledges its responsibility. That is, the management has to give it in writing to the auditor that we acknowledge our responsibility, or it is our responsibility for, or we have the responsibility for accounting and internal control system designed to prevent and detect fraud and error. That is, it is our responsibility to design the accounting and internal control system that prevents, and not only prevents it, if it is not able to prevent, it would detect the frauds and error. Such as the formation of such an accounting or internal control system is the responsibility of the management. The management has to give it in writing to the auditor, right? So this is the first thing which we need to obtain written representation on. The second thing, that the management would give it in writing that it has disclosed to the auditor all facts related to any fraud or suspected fraud. Any fraud which the auditor knew about, any fraud which the management knew about, they have disclosed to the auditor. Or if they had any suspicious thing, whether suspected a fraud or they have had any indication of fraud, they have disclosed it to the auditor. So write it, give it in writing. Then it has discussed with the auditor the results of the assessment. That is, it performed such some assessment of the these in risk assessment of identification and assessment of the risk of material misstatement. I've already covered this. See, these identification and assessment of the risk of material misstatement due to fraud, which I told you is going to be covered in SA 315. So this thing regarding this, the auditor has discussed with the auditor the result. Whatever assessment it made, it has discussed with the auditor regarding those assessment of possible misstatement due to fraud or error. This also needs to be given in writing. Then this is a very interesting point. There are some uncorrected misstatement, and the management feels that they are immaterial. That is, those misstatements are not material. They are not material misstatement. Rather, they are immaterial misstatement. That is, they are not significant. They are not important. So uncorrected misstatements which are still resulting from fraud or error, but in the management's opinion they are immaterial. That is, they do not think that they are significant or important. So regarding such material misstatement, they needs to give it to the auditor a summary of such uncorrected misstatement. They are not correcting those misstatement. Why? They are uncorrected misstatement. Why? Because they think that they are not significant or important. So give a summary of all those misstatements, or give in writing the on the names of basically, or the places of these misstatements in writing to the auditor regarding these uncorrected misstatements. So in the written representation. So a summary of such uncorrected misstatement should be included in the written representation. So this is regarding the management representation. Now written over here that SA 580 written representation gives guidance on obtaining the written representation. If you want to know more about this, you may watch my video on SA 580. Now, communicating to the regulatory and enforcement authority, as I told earlier, told you what was going to be the responsibilities of the auditor. Just a second, I have told you. that it is the responsibility of the auditor to disclose these things to the um, to see over here only. I've told you that you need to just report to the regulatory authority in this in the case that the auditor thinks that he is unable to carry on the audit engagement. So so communicating to those regulatory or enforcement authority, not regarding just regarding these, not regarding those resignation or withdrawal, but about other things as well. The auditor needs to communicate with these regulatory and enforcement authorities. So what regarding what? The disclosure of fraud or error to parties other than the client, senior management, and TCWG. That is, you are disclosing these to not the management or TCWG, but to third parties. Ordinarily, is not part of auditor's responsibility. That is what it is saying is that reporting of frauds and error to anyone other than these management and TCWG is not the responsibility of the auditor, and it is excluded from the auditor's ethical and legal obligation of confidentiality. Confidentiality says that you cannot disclose the confidential and important information of the client to any third party, but under such some circumstances you need to disclose it to the third parties. Now, what under what circumstances? It is his legal or professional sorry however, in the following circumstances, it is the duty to discuss outside the entity may exist, that is to the reporting or regulatory authority. It to comply with the legal or regulatory requirements. As I told you, they give you the example of Reserve Bank of India. In case of non-banking financial companies or corporations audit, the auditor has to report to RBI as per the law enforced. So in this case, he has to disclose with those regulatory authorities. He needs to disclose to the successor auditor, that is again other than the management or TCWG. See, it is these successor auditor are definitely not the part of the management or TCWG. This has been covered under, although there is no requirement to learn this, as per the clause 8 of part 1 of first schedule of Chartered Accountants Act 1949, subject to discussion with the, again you need to discuss with the client. As I told you earlier, that in case you need to communicate to to the incoming auditor, you need the permission of the client. Then to a funding agency, the one who has provided you investment, to one who has provided you the funding. You need to communicate with them in accordance with the requirement of the audit engagement. If there is a fraud and error, you need to communicate to these as well, to the successor auditor as well, and to comply with the legal and regulatory requirement. Example, to the Reserve Bank of India, you need to communicate them regarding the frauds and errors in the entity that you have identified. Now, at the end of the day, in almost every standard on auditing, you need to document things. So the auditor shall document the following in his working papers: the risk factors, and initially I told you what risk factors are. Basically, in the advantageous positions or the things which pressurize you to commit frauds. So the risk factors which have been identified by the auditor, that needs to be documented. What the auditor's response has been to these risk factors, how we responded to them, maybe removing those risks, etc. They need to be documented as well. Then inquiry of the management regarding the risk of fraud, what they have, whether they have assessed the risk, or whether they have any indication of fraud or suspicion of suspicious thing about regarding fraud, that need to be documented again, which you have inquired from the management. Then whether the management has knowledge of fraud, that has occurred, which has occurred. They're confidential. I mean, confident about this, that there is a fraud. Document this, and the entities programmed to prevent or detect the fraud. They might be having a process through which they prevent or detect the fraud. Document that their process as well, or their program as well, the entity's program. So these are some things which you need to document, which the auditor needs to document in his working paper. And so this was probably the biggest standard on auditing video which I've ever made. And this sums up my video on SA 240. You may like my channel and subscribe my channel and like this video, and uh, hopefully you may watch my other videos on standard auditing as well. Thank you so much for joining me.